The Japanese yen is one of the most traded currencies in the world. But did you know that it's also one of the few that sees direct intervention from its central bank? If you're a retail trader that doesn't take into consideration any form of fundamental analysis, you may be sitting there on a normal trading day thinking that the market trend is there for the dollar yen, for instance, and you think, I'm going to continue to buy in this upward trend, but then boom, something happens. You see the yen strengthen significantly, dollar yen drops through the floor, and you're sitting there wondering, what the hell just happened? Well, the likelihood with the yen is the Bank of Japan has intervened, sending the Japanese yen soaring. And in many ways, no one knows exactly when it's going to happen, but you can put some steps in place to make yourself more prepared. Before we dive into why the Bank of Japan intervenes, let's quickly explain what a market intervention actually is. Simply put, it's when a central bank steps into the foreign exchange market to buy or sell its currency. For example, the Bank of Japan might sell US dollars, buy Japanese yen, or do the opposite to weaken it. The goal is to influence the currency's value to prevent extreme volatility that could harm the economy. The Bank of Japan that has a habit that sets it apart from other central banks like the Federal Reserve and the ECB. It's one of the few that actually intervenes in the currency markets, but why? Well, Japan's economy has a few unique quirks. For starters, it's heavily reliant on exports. Think Toyota and Sony. A stronger yen will make these products more expensive overseas, potentially hurting Japan's economic engine. So when the yen is too strong, the BOJ steps in to weaken it. Let's talk about a recent example that rocked the markets. In September of 2022, the Japanese yen had been weakening for months, largely due to a loose monetary policy by the Bank of Japan. On the other side of this, the US Federal Reserve was hiking interest rates. It's created a massive gap in yields, and traders were piling into the US dollar and dumping the Japanese yen. Then seemingly, out of nowhere, the Bank of Japan intervened. It sold US dollars and bought up the Japanese yen, propping up the currency. The dollar yen price fell over 16% in 18 days. So most retail traders were caught off guard. The key takeaway from this is that when the yen moves too far too fast, the Bank of Japan can step in and intervene. Being aware of these signals can save your trades, and if you're on the right side of it, can actually make you money. So how can you stay ahead of the Bank of Japan? Here's some things that you can look out for. First, keep an eye on some significant key levels. The Bank of Japan can often intervene when the dollar yen price breaches through significant psychological levels, one being the sort of 150 or even most recently the 160 barrier. Another key one, watch for verbal signals. Before an intervention, Japanese officials often drop hints, especially around excessive volatility. When you hear this, it's really time to be cautious. Another point is to understand policy divergences. If the Bank of Japan are sticking to ultra low interest rates while other central banks are hiking, this creates that divergence, which means that the yen could get significantly weaker. But don't forget, we cover these kind of insights weekly in our newsletter. Link is in the description below this video. If you found this video helpful, give it a like and subscribe to the channel. We'll see you in the next one.